Is there a Trump bump?
If there is, I guess 17% total return in the S&P 500 in the first half of the year, which is annualized, what, four times the average return is pretty good. I think the risk that people are underestimating about a Trump bump is that we're going to have a definitive election and definitive president in November. Yet we've seen that might not be the case. So I think the market at this stage is priced for way too much optimism, and maybe that we get the Trump bump, but it's so expensive, volatility so low, interest rates are so high. It's just the lessons I've learned. I turned 60 this year. I started in the trading pits in 1988 in Chicago. That when you lick your finger and everybody's really bullish and all they talk about is being bullish, you should look for alternatives.
I agree with, by the way, everything you said there. Where do you see evidence that politics is influencing asset prices and markets?
I think it's indisputable that if we do have a definitive Trump 2.0, I'd say right away that's very bearish for price of crude oil. It means drill it will. I think overall it's going to be bad for the dollar. Most people have said it might be good because of tariffs, but to me it's a bad thing for the dollar because he's trying to help increase U.S. exports and he's pushed back on the dollar before, and pushing back on the Fed is really bad for the dollar. So those are to me some of the key takeaways. And I think the issue I'm worried about is from an equity standpoint. Everybody tells me, oh, the Fed's going to cut rates and Trump's good for equities. We've priced in that about the most extreme I've ever seen in my lifetime. I just look at one thing that I like to point out is something that used to matter. It's almost $57 trillion. That's a total market cap of U.S. stock market. It's 2 times GDP on the way up. The last time we were on a similar trajectory on the way up was 1929. We all know how that worked out. So things are very expensive. And then I look at simple stuff like the S&P 500 versus housing. It's the highest in our database since 1977, since Bloomberg commodity versus the Bloomberg commodity index, highest in 25 years. So the thing I'm worried about is we're priced for so much optimism, realism, just normalization in markets is what we should expect. And typically that's what most people forget when you get to these very lofty levels.
So you cited two statistics there. One was Tobin's Q ratio from a Nobel laureate, where you compare the market cap to GDP, and then the S&P 500 housing. What's interesting there is you're comparing a financial asset to a real asset in both time. And the implication is that these are bounded, these ratios, and there's some kind of mean reversion at work.